So my name is Karan Ahuja. I'm based out of India. I run a portfolio of global investments in the public market, largely focused on the US, with some other geographies as well. Portfolio is a flexi cap portfolio across five to six sectors. I have a background in investment and finance, and have been investing uh, or managing money for the last 7, 8 years now, in different capacities. I've been investing in the US market for over 10 years now, and so have seen a few cycles. And yeah, I've lived in different parts of the world, including Japan, the US, Canada, and I'm excited to be here with the Recompound.
So, emerging markets like India versus the developed market like the US, how do you feel about the difference and what makes you want to invest in the US market instead of the emerging market?
Hmm. That's a really interesting question, given that you and I both are, our core or home markets, so to say, are emerging markets. And I think the flavor of investing is very different. The kind of opportunities you see in emerging markets, are kind of taking that per capita GDP from a couple of $1,000s to hopefully tens of thousands of dollars.
Mhm.
And so a lot of the opportunities are around, financials and basic materials, utilities. In India, you have, very, very large companies that are into paints, for example, or, manufacture sugar or paper. And those are very critical for obviously the development of the country. And so the market also reflects that. And the percentage of innovative companies, I would say, are typically less than maybe 10%, and they don't often show up in the index as well. But that proportion is slowly increasing. And so I think that's one big thing, which is perhaps different from the US, which is that innovative companies tend to occupy a significant part of market capitalization. While, of course, financials and all the other things do form a core as well, but just the amount of innovation that is happening in the US, makes it a very interesting market. The second point I think there is that valuations can vary quite a bit as well. I don't think emerging markets should be seen as cheap, simply because these can often have things like capital controls that keep markets of at a premium. Um, a lot of investors have noted that the Indian market tends to trade at a premium. The index in particular, it's very common for it to be trading at 20 to 25 times PE. That kind of evaluation in the US is seen as quite rich as well. So that's a second difference. I think pricing can be interesting, surprisingly, in developed markets. Um,
I suppose that's a bit of the difference from Indonesia and India as well, because I think India recently experienced a bull market where Indonesia has been kind of like stagnant for like the past years as well. So it's a little bit different.
so it varies exactly, by market as well. And I think third, and I think this is sort of more observational, which is that information flow tends to be a lot more structured in the developed markets. So I don't know if you saw, but Oracle had a massive jump when they reported earnings this quarter, and their market capitalization jumped by like $230 billion, ballpark. And just in seconds, that much market capitalization can move. And that's I was looking up the overall market capitalization of the Indonesian stock exchange, and I think that's total is close to $1 trillion. So what I think, kind of saying is that information gets released in a structured manner in the developed market, and so it feels like a level playing field.
Right. So it makes you feel more like there's more things could be done using common sense and rationality in terms of stock investing compared to emerging markets. Emerging markets, you can like the degree of market inefficiency probably is a lot worse compared to I
Yeah, I think that's well put. I think the informational edge in developed markets tends to be limited, whereas in emerging market it could be the difference between a great fund and a subpar fund. Of course, this is only one part of the overall equation, but I think some folks who are interested in investing in developed markets, especially the US, I take comfort in the fact that most of the market gets to know the information once the company has released it.
Right.
And therefore you can do a lot of the analysis before you don't see the sort of stock creeping up or down before a big announcement. And I think those inefficiencies are there in parts of the market. And I think develop or emerging market regulators are getting better by the day, and they're continuing to make sure the market continues to get as fair as possible.
Right, that's correct. I mean, like in Indonesia, we can see that even before the financial statements or like financial reports are released, like the price action could already move towards the expectation of the release, and then it's already priced in. That's what I'm trying to say. But that's usually for more close observers. So that's a very interesting take on the US in the sense that it's a more level playing field as well. And my curiosity now becomes more towards passive versus active investing as well. Because what I've noticed when talking to potential clients or like potential customers, a lot of them are saying, hey, like how do you know that you are going to perform better compared to me just buying like S&P 500 or like all these passive funds that do not require the investors to actively manage and actively look for alphas or like stocks that they think will outperform against the index in the next year to 5 years. So what do you have to say to people who are skeptical of active management in general?
Look, I think there's a place for both. I think passive management has grown exponentially over the last several decades. It offers a very simple way of doing things. And I think that, as some of the greatest investors out there have noted, that 90 to 95% of all investors should just be doing that. And so in that sense, I think that there is no way to say that it's not good. I think that where we are today is a very interesting place, Toby, because the passive investing space is getting very automated. A lot of algorithmic trading happens within seconds, right? Maybe milliseconds. And because the flow of information is such that it kind of rewards certain kind of behavior by companies. And as you can see in today's market, there's a lot of concentration even within an index. That's relying quite a bit on the AI story playing out. I think time will tell. I think we're all using AI in our lives, but to have the largest index on the planet being driven by 7 companies seems to be a lot of concentration, and perhaps being driven by a lot of the passive investing strategies out there. So I think that passive investing works for a lot of people. And I think that it relies on certain systems to make sure that they get these decisions right. In the past, they have gotten them right. I feel that the level of concentration today worries me a little bit, which is that tomorrow, if there were data points to emerge that perhaps the AI implementation of AI across companies or adoption within consumers might be deferred. I think AI is coming. If it gets deferred, I think the market will read it quite quickly. And I think that indices, which have now stacked up a lot of their chips on the AI story, may need to correct. I don't know if this will happen. I don't know when this would happen, but I think that for something like that to happen, it takes like a couple of new data points to emerge, essentially, and shift the mood. Active management, I think, though, is very much around focusing on the asset within the context of the broad market, obviously, but figuring out if a particular asset is undervalued or not. And I can tell you that there are many companies that have, outperformed some of the largest index names as well over the last couple of years. And you'd find them in, obscure sectors. You'd find them in or unusual sectors, right? Or you'd find market capitalizations of companies also increasing at a rate which, makes the investment by itself very attractive. So it's like, I would say, active management feels a lot more like buying real estate that you think is undervalued, but you have a sense that it's going to appreciate because of certain sort of developments that might happen around that particular physical asset. And I think that in terms of active asset management, what we look at is whether the company has catalysts that will drive earnings growth higher than what the market expects. And so for each company that we invest in, we're able to boil it down to a bunch of key drivers and what we think the market might be underappreciating. I think that active managers do find it hard to deliver value, which is going to be very, very clear to people. But there are enough active managers who do end up also outperforming the index. I think that there is no one sort of one particular investment style that works for everybody. And so therefore, I feel that for a lot of the folks who are looking to get started, I think index investing and active investment both are quite relevant. I think it comes down to each person's risk appetite, so to say.
Right, and the way I see it as well, it's more of like a diversification play that allows you to to kind of like compensate for the underperformance over a certain period of time. Let's say, for example, for active management versus the passive management as well. So if during a certain period of time that active management is more performant compared to the passive investment, then it would be beneficial for the investors to have a more smooth trajectory of seeing their asset growing, I would say.
Yeah, exactly. I think that makes a lot of sense. And I think that within active management, today, for example, the kind of portfolio we have looks very different from the drivers of the index. Our portfolio is very diversified in terms of sectors, in terms of the sizes of companies we've invested in, the stages of companies we've invested in as well. And exactly, so tomorrow, if in the event that some broader market sentiment around AI changes, the portfolio we have, which is fairly diversified, may not sort of go through the same level of volatility. That's the anticipation.
That makes sense. So how did you develop your investment style then? Like selecting which industries you want to focus on while avoiding the AI hype, for example, or maybe just having like a little exposure to emergent industries that is even pre-revenue, for example. How do you manage that, and how do you get the inspiration from developing that style of investments?
That's a good question. So look, I think it's the investment style, I believe, is usually a work in progress, because with each cycle, with each sort of release of new technology or some development, you have to adapt to what the market is showing you. At the very core of it, I believe investment is about finding value. And I think people find value in different sorts of things. One could find value in high growth companies. One could find value in dividend paying stocks. And so I think the concept of value is subjective, but I think all investors out there, and myself included, I think focus on finding companies that will be more valuable in the future than they are today. I think that's the simplest way of saying it. In terms of sectors, how we've looked at it is that at the core of it, when I started investing, it used to be technology only. And this was, close to about 10 years ago, because what was happening back then, around about 2015 to 2017 was there were a bunch of companies that were going public from sort of the new technology space, which included at that time, folks that were operating within the cloud or SaaS players, new age medical devices, etc. And so really started focusing on technology at the outset. Over time, also ramped up, an understanding of the consumer sector, just given how large the US consumer is. It's a segment that one needs to understand. And having spent some time living there, that was something that definitely piqued a lot of interest at my end. And the nuances of that space helped me ramp up coverage on the consumer sector as well. Third sector after that I ramped up was healthcare. I'd previously done equity research within healthcare back in the day. And there's a core understanding as well. And given how large healthcare is as a part of the US GDP, ballpark 20%, it's between 18 to 20% today. It's just a massive part of the economy. And so the goal was to get very familiar and deep into sectors that we understand and believe have economic opportunity that we can identify. So those are the core sectors that we've sort of built the portfolio around. In addition, there's also parts of manufacturing that we like, given where some of the trends in the US are going, that we believe that manufacturing could be very interesting, depending on the opportunity. So those four sectors, I believe, represent a very large part of the overall market capitalization of the broader US and global market. We stay away from sectors that we don't fully see rewarding investors in a very, very big way. But we are very open to ramping up coverage of emerging sectors. One such trend that we really, liked was, and this is before Liberation Day and tariff wars sort of kicked in, but basically looking at rare earth metals, because we did see that there was going to be an increased demand globally. And so that's one sector an emerging sector we've taken a position in. Over and above that, there are certain themes, very select themes within biotech that we like. And again, these are opportunities that today are perhaps not very large. But if some of these play out based on our thesis and what the companies say they're going to do, these could be very large companies that get built out there. So within the emerging sectors, or one could think of these as high beta names. Some companies tend to be more venture-like. So they may have a lot of R&D that's gone in developing drugs, or in sort of creating these facilities which will start revenue generation in the next 12 to 24 months. But these are publicly traded, and I think that's one of the unique points about the US market, which is that it allows for even pre-revenue companies, well-capitalized pre-revenue companies, to go public, and investors such as yourself and me can take positions in those. But the emerging sectors, I think, form a small percentage of the overall portfolio. I would say 10% or less typically, in terms of the cost allocated, or the portfolio cost. I believe that having a balanced view, which is a host of sectors, tech, healthcare, consumer, industrials, along with emerging sectors, gives us enough exposure to the interesting parts of the economy. Now, tomorrow, if another sector becomes interesting, we may look to take exposure through other means. But I think the goal is to keep evolving. And I think coming back to the question you asked, which was, how has my style evolved? I think with each opportunity, you kind of look at it differently. If it's a mature company, I think you're very, very focused. We tend to be very focused on how efficiently the management is running the business. And then there are metrics that we like to see them deliver on. If it's a company that's very early, then I think again we slowly start tracking them, building a position, seeing where market tailwinds, headwinds are going, and then wait for them to eventually become like cash flow generating. So the portfolio broadly, I think, is a mix. The goal is to, again, I think, coming back, can we identify companies that will be more valuable in the future than they are today? The drivers could be different. The driver for a large mature company could be maybe the performance over the next year may exceed expectations and come ahead of consensus. For a venture like company, perhaps most investors don't know about it, and the R&D is happening and the results are coming in. For biotech companies, perhaps clinical trial data is coming in very it's very encouraging, and perhaps it could get to commercialization. So with each investment, there is a different lens, but at the core of it, we're looking for assets which will appreciate. We don't take sort of speculative positions in that sense. We do our analysis to find out, okay, what are the drivers of the industry, what are the drivers of the particular stock, what could go wrong, and position sizing and diversifying there, I think, is a tool we use to make sure that we're well positioned. And so to have about 15 to 25 stocks overall gives us a healthy amount of diversification.
Oh, I can rephrase the question as well, especially just now you already mentioned about your investing approach, which is to find value and to see how these companies are going to be valued more in the future. And I think that's a good approach because we all want to concern ourselves with non-speculative assets and making sure that we have a lot of peace of mind when we invest. But the question is that when you find the right balance between the emerging industries and then the more conventional industries like health, consumer, and tech, especially in the United States, we also see that a lot of people are kind of skeptical with the US economy in general. So what are your thoughts on these people's skepticism in the future?
Yeah, no, maybe I'll try and share my view on the state of the broader US economy, and then we can discuss like implications. So look, I think there are a lot of changes have happened in the US over the last couple of quarters, especially. Clearly, the new administration wants to take the country, the economy in a certain direction, and we're seeing that play out in different ways. The and I think broader context of developed markets is that most countries have significant debt, whereas the economic growth is not as as much as they would like it to be. That said, I think the US has the highest level of growth within that segment of the developed world, which is OECD countries. And so again, I think the US engine continues to hum along, even though a lot of it might be debt driven. So I think they are potentially borrowing and growing their economy. At some point, that big debt issue has to be resolved. I think it's well above my pay grade to kind of speculate as to what might happen, but I think it's a problem that all of us can very clearly see. And if the US has a debt problem that spirals, then I think the entire world is going to be taking note of that, right? If the US sneezes, a lot of people catch cold, as they say. So the economy itself, I think, over the last couple of quarters has been resilient. While the stock market today will broadly tell you that AI is the greatest thing that's ever happened and it's going to change our lives. I think while it could, I don't know if it's necessarily going to drive economic returns. And I believe that people still need to do everything that they need to do as part of their regular lives, which is to eat and buy clothes, get healthcare when needed, use other products when needed, whether it's a car or something else. And so I think that in the mass sort of excitement that's there in the market towards AI, a lot of people are not looking at other things that seem to be undervalued. And so our view is to try and look at those sectors closely while also keeping an eye on the AI sort of basket, so to say. So we do have exposure to particularly to AI, I'd say about again closer to about 10% of the portfolio. So we're not totally missing out on that. But I think that if you have to say that there's a portfolio that can, that doesn't need to be touched too much over the next couple of years, I'd rather have it be diversified than be focused on just one sector. And so as we look at the US economy, it's going through some significant changes. We're seeing big tech, a lot of companies laying off people en masse, thousands of jobs are being are disappearing from these companies, where we will see some of that potentially play out in other numbers within the economy, whether it's consumption, whether it's real estate or somewhere else. That data is not clear yet. But I do believe it's a very dynamic economy. I think the US has the talent to kind of retool their skill set, start things that are, perhaps not seen today. And so I think that it's a large enough economy to be able to absorb some of the smartest minds that might be getting laid off for, reasons beyond their control. But I think the big tech companies are using the AI moment uh, to rationalize their costs so that in the future they're going to be ready for any massive disruption that happens. And I think which is part of the interestingly part of the thesis why I started investing in the US, which is that the companies are very often highly efficient. And I think it goes on to show, at least in my view, that they're also the first ones to start cutting jobs when just a little bit of AI adoption has happened. And so it tells you that in terms of corporate governance, these guys take um, returning sort of value to shareholders very, very seriously. And I think that bodes well in the long run.
Nice. Right. And especially when you mentioned about the U.S. economy being a super dynamic space in general, with a lot of changes and a lot of disruption that is happening left, right, center, with AI being one of the main driving forces as well. I suppose that you always have to really be keeping yourself on top of the game at all times, especially with regards to monitoring the companies that you decide to invest, and then keeping track with the management, the maximizing of the shareholder value. How do you stay on top?
Yeah, yeah. Look, it's a bit of a bottomless pit, to be honest, which is
Of course.
so I think,
So yeah.
yeah, the investment process starts very early. I think kind of going from 0 to 60% is one bit of the, really understanding a sector, companies within that, broad dynamics, then going from like 60% all the way to like 80%. And then the last bit is sort of going from 80 to 99%. I think there's no 100% out there. You can't know everything about a particular company. You can know many, many things. I think once the investment has been made, and sort of part of the investment process actually is a lot of primary and secondary research. So I think there are a lot of tools available today. There are, I've spent time in North America, with personal networks, just to get a sense of, what might be happening in certain parts of the economy. Over and above that, once the investment has been made, really, I think tracking obviously news and filings, fairly standard there. And then trying to look for like new ways, alternate data sources, different types of signals. And I think that the world we live in, I think there's no dearth of signals that companies might be emitting. And I think there is you kind of have to hone in on that and figure out uh, which signals to actually ignore and which ones to take account of. So a lot of time is spent, yeah, thinking about what might be happening with different sort of portfolio companies and the broader sector, because there'll be companies that we may not invest in today, but are tracking, and so at maybe once they cross a certain maybe there's a particular catalyst that makes us more eager to invest in those companies. So we track like quite a few companies, much more than the number of portfolio companies we have. So yeah, I spend a lot of time reading. That's I think how most of my day is spent. And then I think also just trying to get signals on the ground by visiting these markets from time to time. That really helps get a pulse on what's happening on the ground. I do feel that being a little distant helps, because you're not always you don't get carried away by the crowd as much, because you're not sitting inside. You can take like an independent view a little more, like a little more firmly, than getting swayed by the crowd. Which is why I think maybe I've positioned my portfolio in a way where I feel that if there is a move away from certain sectors, some of the other investments should benefit.
It is a nice way of saying it as well, having a little bit of distance between yourself and the economy, so that you don't really get drawn by the sentiments of the crowd as well, and you can you can detach yourself from the in and out of the markets in general. What I'm interested in as well is, how do you differentiate between the signal and the noise? Is there a simple framework that you use, or is there like a accumulated wisdom that you have developed from the beginning of your investment journey all the way until now? Because there's just so many information out there, and it's like you mentioned, it's bottomless pit. So you kind of have to see what's an important information, distinguish it between that and obviously noise.
Yeah, no, I think that's the million or billion dollar question, right? Which signals to pick up and ignore. So first up, it's a work in progress. It's always sort of evolving, because new type of signals can emerge. So I think one is certainly sticking to the basics in terms of, what is the company reporting and what is the company CS saying. And I think over and above that, start getting building sort of trusted sources is a core part of the job, as you kind of rightly alluded to. Um, and it takes time, because I think that right sources, these could be, sources that you have, or whether it's like anything from a product that you're using, a service, or it's a parts of social media, or some other sort of platform you can access. It takes time to develop those, and for each sector company, it could vary a bit. But I think in all of this, I think when there is an overload, what feels like an overload of signals, I think sticking to the basics helps, which is, are we okay in terms of quality of management? Are we okay in terms of quality of earnings? Are we okay in terms of, broader sector tailwinds and headwinds? And as I think as we have sort of seen in the recent past, half of the news is getting broken on social media.
Mm-hmm, mm-hmm.
Um, and I think it's becoming that narrative-driven sort of period right now, wherein you hear first things on, whatever social media platform you're on. Um, and I think that it's good to know what's happening, but I think it's important to then take an independent call. And I would say that you're not going to get everything right. That's very, very rare. Um,
It's impossible.
It's impossible, perhaps. Yeah, right. So I think you have to kind of process it based on your style of investing. So yeah, when there are too many signals, I try and stick to the basics. Yeah.
I think that's very well said as well. You stick to the basics. You look at the company, quality of management, quality of earnings. A lot of people say that when you look at you have to you stick to the basics, and then it gives you a lot more clarity compared to confusion. And I think the building up on the trusted source as well is very, very important to underscore the importance of experience as well as accumulated wisdom when you start investing. And obviously, the response that you give makes me curious as well, because you've also been an investor in the private sector, leading Series A, Series B rounds for startups. And how do you feel about the difference between your past or previous life as a private investor compared to today as more of like an investor investing in public companies?
Yeah, yeah. No, great question. I think two different sort of asset classes, private investments, private equity, venture capital versus public equities. At the core of it, though, I think there is a company with uh, a management team that's ideally very motivated to take that company to new heights. I think in the private space, obviously, it's a much longer term partnership, a personal relationship as well with the management, perhaps an active board role as well, where you can influence decisions. And so I think that journey comes with a fair amount of all journeys will have volatility. And therefore, you have to be very sure that you're going to be there for maybe 5, 7, 10 years, through thick and thin. And I think it's a much deeper partnership. I think public investing in that sense, I think while the entry and exit are much easier in today's world, maybe too easy, where click of a button on your mobile phone. Um, the core, I think, is still the same, right? Which is the quality of management, quality of earnings, growth, like that. I think though, what we've done is whereas in private investing, there would be a lot of management meetings, and I think that can influence your decision making, right? Which is a particular team, which, is, talking about the future a lot more. One could get, one could assign it a certain positive weight or a negative weight depending on the situation. Whereas I think in public market investing, your median company will have very solid financials. They'll have lots of data points, and then you can evaluate whether or not they're saying is going to play out the same way or not. And so I think that there private investing will give you tons of uh, data points which a public company will not give you. But I think public investing is, while both are challenging, I think it comes down to the kind of uh, you know investment style you have, and what kind of you know uh, time horizons you like to keep. And so yeah, I think that I've learned a lot from private investing. I think the emphasis on the quality of management for me has, shot up quite a bit during my time there, and I think I'm trying to apply that in public investing as well. You don't have the same access to management. To some extent, we try and keep that limited as well to keep the distance between the very objective view versus potentially subjective view. But I think that's my biggest takeaway from private investing, which is focus on quality of management. Financials are there for everybody to see.
Yeah, and I would say 100% agree, because the quality of management really determines the quality of the company as well. Especially in Indonesia, we really look at the track record of the company financials and how the management allocates capital, and as well how honest is the management in maximizing the value of the minority shareholder as well. Sometimes people say that, oh yeah, distributing dividends is good, but then it's not always good. It depends on what the priority of the management is. Do they just want to enrich themselves one-off, or do they want to keep on distributing dividends, or do they want to reinvest the proceeds from the company earnings and so on and so forth? So it's even more emphasized on private investment as well, because private investments is more long term. So you need to make sure that you are basically backing up the right people to help the company achieve greater heights, as you mentioned. Yeah. Cool. And when you transport the lessons that you've learned from private investing to public investing, or like investing in public companies in general, could you share some of the biggest investment wins or like investment mistakes that you can comfortably share with us?
Yeah, so I think that there have been a lot of those. So I think in one phase, in the early phase of my investments, I think I sold out of some positions to allocate capital to another position. And I think that that could have kind of played out very differently if I had not. To give you an example, I had a position in Apple back in 2016, because of this view I had around how they're, sort of how they'll continue to do well. However, at that time, there were a bunch of very interesting new age IPOs that came out, and I had to reallocate capital in that situation. So I actually sold my stock in Apple to put it in something else. Now, this thing went, it went 2, 3 times over the new
Yeah.
investment, but Apple went up like 12 times. So while the near term sort of reallocation was interesting and attractive, in the long run, I definitely missed out on sort of the compounding to happen. I think that's one. Second, I think in the zero interest regime during COVID, um, the number of companies that came again to market or were kind of retooling themselves for a COVID world, um, I think it threw like a lot of names at all investors. For me, I think um, getting into some positions and kind of quickly realizing that they're not going to be long-term winners, I think was another sort of learning for me, which is, I think if you kind of realize that you have made a decision that is going to not be durable, or the thesis is not going to be durable, I think you should kind of get off the wrong train if you've gotten onto it. And I think for me, while I think the returns have been in some of those companies were fine, I think that um, in hindsight, I should perhaps have avoided them completely. Um, so I think selling some of the uh, long-term potential compounders too early was one thing. I think making money in companies that were in the long run not sustainable, I think for me didn't bode very well with my investment philosophy. But it did happen, right? It did happen during the zero interest period where I think nobody knew what the future really held. Um, and I think that in all markets, there will be certain types of companies. Today, I think, again, I mean, I don't mean to belabor this, but like even within the AI space, there are a lot of speculative names out there. And I think there are people who are making money, but I doubt some of them will survive. So trying to be thoughtful around even within some new age companies, which ones will really, really survive. Because in an ideal world, you want to hold on to investments for as long as possible. Um, so trying to get to a place where churn needs to happen. It just should not, uh, you know, uh, be something that keeps you awake at night. I think that's the goal.
Yeah, so the mistake shouldn't be too costly.
Yeah. Mistakes should not be too costly. Mistakes will happen, but yeah, they should not wipe you out. And that's the goal, right? Which is why I think diversification is important in every way possible. And not everything will work out, but some positions which might be small may surprise you as well. So, I think in all of that, I think you have to give yourself enough time.
That makes sense. Makes sense. And when you shared these stories as well, I think it's very, very similar to what we experience as well when we invest in the Indonesian capital market, especially when you see that some of the stocks that you used to hold, they turn out to be the long-term compounders, and then they, even though you switch to a stock that is also growing in a sense, but that feeling of missing out sometimes can be a little bit painful, and you have to really manage your psychology well. So I'm thinking, how do you manage that behavioral part in investing, because it's not an easy thing for every investor to manage? And what has been the role of psychology in your investing journey so far?
No, very pertinent point. I think with the advent of AI, informational access is sort of similar for almost everybody now. Um, I think then there is the analysis part, and then I think there is the emotional part, which is how do you manage your psychology, or how do you respond to what the market is doing. So again, I think I want to reiterate it's a work in progress, which is to one, recognize that it's a big part of what can drive returns, and do something actively about it. So I think for context, I think we all live in a very a dopamine stimulated world, with short form content, instant hit, instant delivery, etc. And I think um, that's always going to be something you'll have to kind of manage while looking at a very long term horizon. Um, so for me, so I think in terms of psychology, yes, on good days when the screen is bright green, on bad days when the screen is bright red, trying to not take it, uh, trying to take the market signal for what it is rather than taking it personally, which is that tomorrow if like some external event happens that causes things to go up or down, trying to I think just dissociate a little bit from that. Um, if there is something that's happening in a particular, I think, company, I think then it's more about really going in and seeing what happened, right? Like, was there something that got missed or something that came out of the blue? Trying to kind of do like a, so to say, an analysis of what might have kind of happened. Um, and I think then outside of markets, I think trying to do things to keep the overall well-being on track, physical health and mental health, because I
Sure.
think market, and perhaps you've noticed as well, but markets have become more like they gyrate a lot more now. And I think that's because of just the level of quantitative trading, options trading that's there in the market. And so one little news can, as we saw with again Oracle, big number, but that they reported a massive stock movement. Small things can like lead to very, very large movements. And therefore, trying to see within those movements if there's opportunity, right? Because I think that markets and crowds can be irrational for long periods or for very small time periods as well. And then I think trying to find opportunity within that, I think, is the psychology element that I kind of think through quite a bit. And so it's a work in progress. I don't have one single silver bullet, but the goal is to at least be aware of the fact that there is this one big component that will drive returns. So trying to work on it as we speak.
Yeah, and I think it makes sense as well for you to take care of your physical and mental well-being as well when it comes to managing your psychology surrounding the market, because it can get too crazy out there. One day is green, one day is red, and then being aware of these things that happen, and it's nothing personal against you, but it's more of, okay, so how do we take a look at the issue, and should we react to this or not? Should we what should we do after the information is available for us to make use of? And I think this has been a super great conversation as well, because understanding like how investors like yourself, for example, operate, and then your views, which is you operate in a different market. Like the US is very different from Indonesia. Indonesia is largely like similar to India, commodity rich, and then emerging with all sorts of domestic and local shenanigans, I would say. It's very different compared to the market in the US. But then the same investment philosophy, or like the same investment approach in making sure that we win long term, and then we stay in the game, and then we make sure that we stay calm during uncertain times, and then we look at the quality of the management. It basically gives a nice, a nice similar frequency level, I would say, between like the approach that we are taking. Thank you for tuning in. If you want to see more about Recompound Global and Karan Ahuja, please see the links in the description below.